This is lecture number 4, the risk and term structure of interest rates. In this particular lecture, we are actually going to talk about uh, what exactly, are the secrets behind the risk and return structure of the interest rates, because, like the interest rates that you get on the bonds or any kind of investment instruments will be depending on the term for which you borrow or lend money and the risks that you take. As you know that higher is the risk, higher is the return. Technically, generally it happens that when you are willing to take more risks, you generally get higher returns. So it means that if you look at the relationship between the risk and return, it should be a positive relationship. Similarly, if you look at the relationship between the term and the return, like say, for example, if you lend your money for a short period of time, you get smaller interest rates. But if you lend the same money for a longer period of time, you get higher interest rates because you freeze your money for a longer period of time. So you actually want to be compensated for, for the amount of time that you are actually making the compromise about. So understanding about the relationship between the term means maturity period and the risk that you take and the return. Like that is very crucial because when you make any kind of investments, like say for example, if you are going to make any kind of investments, you should be aware of that what exactly are your returns over the period of time that you are basically investing your money in, and what kind of risks are you taking. So we actually have been talking about this particular kind of a concept here. So like about the interest rates and yields means return, of course, on credit market instruments of the same maturity vary because of the differences in many kind of things. Like say for example, if there are two bonds which actually are going to be matured in 1 year, so it means that the maturity period of the both of the bonds is the same. But the return of the both of the bonds will not be the same. Why? The reason is that both of the bonds have different kinds of dynamics, and these dynamics are in terms of the default risk that you are basically, like the party which is actually borrowing money from you. What is the probability of its default? Its default means what are the chances that the party will not pay you back? And secondly, the returns on your instrument will be depending on that how liquid is the instrument, how quickly you can convert that particular asset into cash. Like say, for example, it means that how active secondary market is available to you. If the secondary market is very active, the secondary market is very prevailing in the society, in the economy that you are operating in, that is very easy to take your bond or any kind of the instruments to the market and get it cashed. Similarly, other kind of market conditions, are the market conditions good, bad, people are investing or not investing, are the people are willing to make more investments or less investments. So it is something, it also depends on the other kind of the market conditions. In some of the conditions, like when the markets are in good conditions, generally the people are able to borrow or lend money at a smaller rate. But when the markets conditions are not good, in the sense like that they are expecting the markets to be volatile or markets to be more kind of having some problems in the future, people expect more. Similarly, inflation expectations, you all know about the real interest rates, real returns of the investments, that whenever you make investments, you always judge the return which you are getting from the investments or compare the returns that you are getting from the investments to the purchasing power. Like what do you look at when you make investments? Like say for example, when you make investments, you try to increase your purchasing power in the future, but that purchasing power hurts when the inflation in your country increases. So you always have to look at that what kind of inflation are you going to expect over the period of time for which you are going to make investments. Like say for example, if you are buying a bond, say for example, for 1 year, what kind of inflation are you expecting in the next year? Because that rate of inflation will determine that what will be the value of the return or the money that you will be getting at the end of the term. It will be in terms of the purchasing power, in terms of the buying of the goods. Like say for example, we have discussed this example many times, in earlier lectures, that if you are investing at 10%, say for example, you are investing 100,000 rupees at 10%, at 1 year, after 1 year, you will be getting 110,000 roughly. All right. Now, you are going to get 10,000 rupees extra on the top of 100,000 rupees. Now, what does that mean? Does it mean that like you are also able to buy 10% more goods? The answer will be depending on the inflation. And that inflation expectations will determine you that what kind of purchasing power the extra 10% will have in the future. All right. Of course, like, along with the 100,000 rupees, the principal amount's purchasing power will also fall on the basis of inflation. Similarly, like there are some instruments which have got tax considerations. Like, say, for example, if you go to many investment companies, they would offer you that if you invest in our products, you are going to get tax rebates, you are going to get tax kind of holidays on this, or you are going to get a rebate on your income tax, because there are many schemes available in the investment companies where in the mutual fund industry or in this investment, like, market, where you can get some kind of tax rebate if you are making investments into certain kind of a products. Okay, so if you are talking about the risk structure of the interest rates, and they are basically, they are the determinants, as we have talked about, these determinants, like, say, for example, default rates, liquidity, market conditions, and they're all. So these all actually are collectively creates a risk structure of the interest rates. And the relationship among these interest rates is called the risk structure of the interest rates, that how the risk basically, changes the return. Now, there are some sections that are needed to be highlighted, like, say, for example, default risk. The very basic risk that you take when you make investments at any place is the default risk. Like, say, for example, the money that you give to somebody is not coming back to you. There may be some kind of a situation, like, say, for example, the person who has borrowed money from you may actually have losses in his business, or may have got problems in some other kinds, and he may deny payments when the time comes for the payments. Like, say, for example, when you go to get your interest rates, they say, like, we couldn't have profits from your investment, so we are not going to pay you any interest. Similarly, when you are go to get back your principal amount, they generally may also say you that, like, say, for example, we don't have money because we have lost money into the project, so we are not going to pay you money. So this is called default risk. Like, as you know, Sri Lanka basically defaulted on its sovereign loans. The sovereign loans are the loans which government takes from the people or other governments. So when these governments do not have enough money to pay you back, like, say, for example, in Pakistan also, you must have heard about that Pakistan has been at the verge of default, or that was actually at the verge of default at that particular point of time, or this particular point of time. What do they mean by that default is that, like, the government does not have got enough money to pay interest or the principal amount which it actually has borrowed from the general public, because the government, to meet with its budget deficit, borrows locally and internationally. And whenever you make the borrowing, you have to make interest payments, and you may have to return the principal amount at the end of the maturity period. And if you are not able to do that, you may default on the payment. Now, what kind of premium you expect? Like, say, for example, if you are comparing government bonds with the corporate bonds, corporate bonds are the bonds which are being issued by some corporations. Corporations means companies. The companies basically, issue some bond, and that bonds basically are issued to borrow money from the local market. Similarly, the governments also issue bond in the market to get actually money from the people, and to just meet with their budget deficits or other kind of deficits, or to just meet with other kind of the projects. But technically, if you compare a bond of the government and the bond of a company, I hope you are able to understand that the company's bond is riskier than the bond of the government. Why? Because the government is a very big entity. Government actually has got a lot of money. The government also has got the power to print money. And the governments actually are more responsible in terms of the payments they have to make, because they cannot default on their payment, and it's not easy for the government to default on its payment. So it means that the government's loans are more secure as compared to the corporate loans. Now, if you say, for example, what exactly is happening here? Like, say, for example, if you look at this situation here, if the default risk increases, what happens? The demand for the government bonds increases. Like, say, for example, look at here. When the default risk of the corporation increases, what happens? When the default risk of the corporation increases, you may see the fall of the demand from D1C, which is the corporate demand for the corporate bonds, and the one is the initial level of the bond curve, and this is the DC2. DC2 is a demand for the corporate bond too. And now why is this demand falling? Because the default risk is increasing. Because the default risk is increasing, so the demand for the corporate bond is falling. And now what exactly is happening, that this fall in the demand curve for the corporate bond will cause the rise in the demand for the government bonds. So what exactly is the premium that people require if the corporations want them to back? Like, say for example, this is the premium. Like, say for example, this is what is happening. I was trying to relate the fall in the demand for the corporate bond because of the increase in default risk to the rise in the demand for the government bonds because of the security, or because of the, like a kind of, insulation of the government from the losses. So the people increase the demand for the government bonds when the default risk on the corporate bonds increases. Now you can see here that due to fall in the demand curve for the corporate bonds, the price of the corporate bonds will fall. Price of the corporate bond will fall in the sense, like, that the people will be demanding less, and of course, where the prices will fall. And what will happen with the price of the government bonds? The price of the government bonds will increase. Okay. Now this is the difference between which actually you actually as a risk premium you require if you really want to go back. Like, say for example, if you are taking this kind of a risk, if you want your people back, you have to give this amount of the risk premium. This is what basically is something. So, like what happens here is that you actually need this kind of a risk premium if you really want, like, because if you are willing to take, like, say, for example, if the corporations basically want you back, they will have to provide you this kind of risk premium. They will have to increase the return by this particular amount so that you could basically shift again from government bonds to the corporate bonds. Okay. So this is a very basic calculation. I hope you are able to understand this. If you are not, please, you may ask your questions. And like this is the basically, like this is the kind of a case I was telling you, that if the default risk increases, the premium increases, the risk returns are basically the returns you want on the bonds increases. And this is the basic calculations, and we are basically trying to compare the fall in the price of the corporate bond and the rise in the price of the government bonds. The reason is that the default risk on the corporate bonds is increasing as compared to the risk on the government bonds. Okay. So this is what basically is the case. Another factor that is needed to be considered at length is the liquidity, because investors actually care about the cost required to convert financial instrument into cash. The cost not only in terms of money, the cost in terms of time as well, that how quickly are you able to convert your instrument into cash. Like, say for example, if you are trying to sell your car, how easily and how quickly are you able to sell your car? That will determine its liquidity. Like, it will determine its market acceptance. Like, say for example, how many people are willing to buy the car that you are selling in the market, and how many people are interested to pay for the car that you are basically selling. Something similar happens with the financial assets. The financial assets basically are kind of assets that you need to encash in case of the like need, or you basically want them so that that, say for example, if you want to make another investments, or you want to withdraw your cash from the assets, you may basically like sell your assets, and for that you need liquidity. So it is something similar happens. And one more thing that basically happens is that, so that less liquid assets or an illiquid assets must pay a higher yields, because like that is not basically going to, you are not basically going to encash it for a longer period of time, for quickly from the market. So that basically can affect both the risk and term structure of the interest rates. So if you look at the term structure, what is the term structure? The term structure is the relationship among the interest rates on bonds with different terms to maturity. With different terms to maturity. Like, say for example, if there are two kind of bonds that have got same risk. but like their returns will not be the same. Why? Because the return will be depending on, along with the risk, the term period for which the lending and borrowing is taking place. Say, for example, there are two bonds, which both of them actually have got 10% default risk. But that 10% default risk, of course, is the same for the both bonds, but the returns will be depending on that for how long the first bond is asking you money, and for how long the second bond is asking you for money. Like, say, for example, if the one bond's maturity is 1 year and another bond's maturity is 2 year, then it will be a difference basically of the maturity that will define the interest rate on that bond. So here we are actually going to examine the sources and causes of fluctuations in interest rates relative to one another and look at different theories that explain these fluctuations. Before that, you need to understand a very strong term, and all of the finance uh, actually talks about this, which is called the yield curve. Yield curve, what is the yield curve? Like yield, again, if you remember, by the yield we mean return. This is, or the interest, of course return is a bigger term than interest. I told you that return not only includes the interest rate but also includes the capital gains or capital losses. But this interest rate is the yield on your curve, on your basically on bonds. So a line that plots yields, which is the interest rates, which is the interest rate return on your bonds, having equal credit quality but differing maturity dates. So what exactly the yield curve does, yield curves measures the return, which are the interest rates in this particular instance, in relation to the time period for which the money is lent or borrowed. Okay, so this is the yield curve. So how a yield curve works, the yield curve plots interest rate across different maturities of similar securities. It is visual presentation of the term structure of interest rate. Like, say, for example, it will tell you what interest rate you will get on 1 year bond, and what interest rate you will get on 2 year bond, what interest rate you will get on 3 year bond, 4 year bond, 5 year bond. So the interest rate, if you link with the maturity period of the bond, that may define the yield curve. So what exactly it does, it is a visual representation of term structure of interest rates. Visual representation. It represents a graphical presentation of the relationship between the interest rates and the time periods involved in the maturity of the bond. It indicates prevailing market expectations for future interest rates and economic conditions. So, like what exactly are you expecting in the future? Like, say, for example, how big interest rate you are expecting if you are going to make in longer term investments. That will be depending on the economic conditions, market conditions, your inflation expectations, and everything that basically is related to this. Now, what is the importance of yield curve? Why do we study yield curve? In other words, the yield curve, of course, is a fundamental tool for understanding the interest rate environment. What kind of environment is there of the interest rate? It exactly shows you that how interest rates may vary on the basis of the time the funds are invested for. Like, say, for example, if the funds are invested for 1 year, the interest rate will be different from the funds if they are invested in for 2 years. It has very, very significant implications for borrowers, investors, and policymakers. Now, look at this. This is the simplest kind of a yield curve. What exactly is this yield curve representing? Again, this is a visual representation. Visual representation between what? Between the term to maturity. The term to maturity can be 1, 2, 3, 4, 5 years, say, for example, and interest rates on the different kinds of bonds. Like, say, for example, if you invest at 1% for 1 year, you get certain returns. For the 2 years, you get another return. Third year, you get higher return. It is just a normal kind of a yield curve. So the term structure of the interest rate is the relation between the different interest rates for different terms to maturity loans. So if we observe 8, 9, 10, 11%, they are all basically, are showing the interest rates for the different kinds of periods. So this is called the term structure. And again, what does this term structure representing? This term structure is representing the relationship between the term to maturity and the interest rate, which is the yield on the bond. The bond yield, like say for example, the yield that you get, like a farmer gets from the land, is the output that it produces from the land. Similarly, the bond that you buy, or you just invest through, like you invest your money through the bonds. The return that you get in terms of the interest rate is plotted on the y-axis, and the time to maturity is basically plotted on the x-axis. And this relationship, which is an upward relationship, is the relationship between the maturity period and the interest rates. Now, as you are looking at this diagram here again, this diagram actually has got the curve, which is an upward sloping curve. But technically, this cannot or will not be always an upward sloping curve. Generally, it's a normal kind of a curve, but there are different kinds of the shapes of the yield curves. Like say, for example, some of the yield curves are upward sloping, some are downward sloping, and some may be flat. Of course, that will be depending on that how people expect to change their interest rates when the term periods changes. That will be depending on a lot of factors along with the term periods, along with all other kind of the factors. So we will be looking at that when do you have an upward sloping yield curve, when do you have downward sloping yield curves, and when you have got a flat horizontal kind of a yield curve. So upward sloping yield curves. When do you have got upward sloping yield curves? Upward sloping yield curves are the long-term yields, are if that happens when you have long-term yields which are greater, like in the longer run, than the shorter run. Like if your yield, which is technically happens, like generally the yield curves that you have got are upward sloping, but in some of the instances we may have got the downward sloping or flat yield curves. But technically and generally, we have got an upward sloping yield curves, and yield curves are upward sloping whenever people expect to have higher interest in the longer run as compared to the shorter run. So this is the normal slope of the yield curve, and it signals that the economy is in expansionary mode. Like say, for example, when the economy is expanding, economy is getting better, you are basically going to get better returns in the future. So things basically are normal, and things basically are going in your way, okay, or in the good way. You may also have got the yields which may be falling over the longer run. In that instance, your yield curve will be downward sloping. This actually happens when the opposite happens from the above instance. Like say, for example, in the upward sloping yield curve case, you expect your interest rate to increase in the longer run. In the downward sloping case, you expect your yields to fall in the longer run. There may be a lot of reasons for it. What reasons are we are going to discuss, and we shall also be looking at the theories that may explain the possibility of upward, downward, or flat yield curves. So it is dubbed as, or it is called as, an inverted yield curve, and it signifies that the economy is in or about to enter a recessive period or recession period. When your economy is expanding, everything is happening good, people are basically making investments, there's a demand for everything is increasing, more returns are coming from your investment, so you basically are expecting the things to go up and you actually things to go better. Like say, for example, if you are buying a house in an expansionary economy and you are buying a house in a recessionary economy to sell again to get the profit. Like say, for example, if you are buying a house in an expansionary economy, you should expect to get better price in the future for the house that you have bought for investments. But if your economy, you are buying the house and is in recession means its economy is falling. So you may not expect higher price for that house in the longer run. Rather, you will be expecting lower price for that house in the longer run. I hope I'm making sense to you guys. So when your economies are in expansionary mode, you may expect your returns to increase in the longer run. And when your economy is in recessionary mode, you should expect the economy to to go down, and you should also expect the prices of all the valuable assets will fall in the future, because the overall economy is not in a good mood, or the economy is not working well. So when do you have flat curves? The flat means the same constant horizontal. So it happens when the difference between the short and long-term interest rate is negligible. So what does it signal? It signals that the market is not sure about the future direction, because if the market is sure about that the future is going to be good, markets are going to expand, so the interest rates increase. But if if the markets think that the economies are going down, the interest rates falls. But if the market is not certain what exactly is going to happen in the future, they may be having a trouble, like in deciding that what exactly will be the return in the future. That will remain the same, that will not be changing. Now on your screen, there is a table showing the ratings by Moody's and Standard and Poor's and Fitch. This is a table that is representing, like, different companies' ratings. These ratings are basically very important before making any kind of investment, so that, like, when you look at any kind of the ratings of a company or country, you exactly find out what exactly are you going to get into. Like, it is as same as that when you buy anything online, you try to judge the quality of the product through the customer reviews. The customer reviews tell you, like, say for example, if it's a 5-star customer review product, you may trust in that product. But if it is a 1-star kind of a product, you may not trust on that particular product. Like, say for example, if you're buying some expensive machine, and you will not be buying such machines which actually has got a rating of 1 star. 1 star means people generally don't like it, because people don't feel that it is as good as it should have been. Something similar ratings come from the rating agencies, and these basically rating agencies are very important. Like, say for example, in case of Pakistan, recently Pakistan is struggling in maintaining its rating, and the reason is that we have got all kinds of instability in our country, economic, political, social, and every kind of instability we have got here. And we have had elections, but we don't know what kind of government is going to be formed and how this government is going to survive in the future. So there are a lot of troubles basically Pakistan is facing. In that particular kind of a case, what kind of expectations you may have got, what kind of expectations these rating agencies will give you, how good they will rate your investment. Like, say for example, how good these companies will rate investments in Pakistan. Of course, the ratings will fall, because they are not expecting to have continuous and safe returns in the future. Okay, so this rating starts with AAA and ends on C or D in some of the instances. And every rating basically, as the students basically are of the A grades, B grades, C grades, so you can see, that the quality of a student depends on that, what kind of grade he gets in the exam. Something similar happens with the companies. So the companies that have got higher ratings, it means that they actually are less riskier. Like, say for example, if you look at, if a company is getting the rating of AAA, it means that whatever investments you are making, it is primarily maximum safe. If it is AA or AA minus, according to Standard & Poor's or Fitch, it is high grade. And as you move down, you can see here that, that lower medium grade, non-investment grade, it is speculative, highly speculative. Speculative means it's highly volatile. You may speculate, it depends on the speculations. If the speculations goes good, like, say for example, right now, what is happening with the Pakistan stock market and Pakistan's exchange rate market, everything is very, very speculative. Like, every time people are speculating that what exactly is going to happen in Pakistan, and they are basically are deciding about this in this way. Okay, this particular the theories basically that are popping up on your screen basically are the theories that explain what kind of what kind of explanation you have got for these 3 different kinds of slopes of the yield curves. Like, as you know, we have talked about that the yield curve may be an upward sloping curve or downward sloping curve or a flat curve. That will be depending on the different kinds of, for that explanation we study different theories, which may actually define you that why do you expect a curve to be upward sloping or downward sloping, or a flat curve. The first theory in this particular regard is expectations theory. What is expectations theory? As you remember, or you must have learned in your statistics course about the mathematical expectations. What is the mathematical expectations or expectations? Expectations means average. Average returns. The averages generally depend on the the extreme values. Like say for example, like whenever the value at the extreme changes, the value of the average changes. Like say for example, if you have got a different kind of a situation today and a different kind of a situation tomorrow, now if you take the average of it, this average will be depending on that how the situation is changing. Okay, we'll be taking an example here, and that expectations will tell you that what exactly are you expecting in the future, and that expectations overall average return will be depending on the returns or the different short term basically that you are getting on. We'll be discussing about it. Another theory that is used to explain the shape of the yield curve is the segmented market theory. As you know that we or any kind of a businesses basically like do the market segmentations. What is the market segmentations? Like say for example, if you are flying through a plane, you generally have got three different classes: economy, economy plus, and business class. Now, why this market has been divided, or why this plane has been divided between three different kinds of classes? And one class, the people who are sitting, they are paying very low price for the ticket as compared to the people who are sitting in the business class. Similarly, the people who are sitting in the economy plus or in the middle kind of a class, they are paying the value in between the two extremes. Okay. Now, why is this market divided between the segments? Because different people value different things in different way. Like say, for example, the people who are traveling in economy, they value more to economy and less to luxury. The people who are actually flying in the business class, they will be giving, they give generally, more value to, like luxury than the economy. So this is something similar happens in the bonds market as well. The bonds market basically also have got situation where you have got a problem. Like say for example, some of the people like something, some of the people like some other things. So that actually is something like that. So another is the liquidity premium theory. How much liquidity, how much value you give to the liquidity. Like when you compromise your liquidity for longer term, you basically expect higher returns. When you compromise your liquidity for the shorter term, you may expect the small returns. So we will be talking about these different kind of theories one by one. Now, first of all, the expectations theory. Now, what is the idea of the expectations theory? The idea is that uh, the shape of the yield curve is determined by the investor's expectations of the future short-term interest rates. As you know, that the long-term interest rate or the long term is a combination of different short terms. So in the short term, what kind of return are you expecting in the first short term and in the second short term and the third short term? Overall, in the long term, the overall return will be depending on the average of these three terms. Like say, for example, what returns are you expecting in the 1 year investments today, 1 year investments in the next year, the 1 year investments in the next to next year, and if you are like like at the place of that kind of individual investments or different investments, if you are thinking to make investments over the next 3 years, you will be actually calculating the average and you will be finding out that what exactly return are you expecting from your investments. So the idea again is the expectations theory suggests that the shape of the yield curve, the shape of the curve that plots the interest rates against the time period, is determined by the investor's expectations of the future short-term interest rates. Now, what is the explanation of this idea? So if investors are expecting short-term interest rates to rise in the future, like this year's interest rates are lower, but the next year's interest rates will be higher, the yield curve may be upward sloping, which is normal. But if the people are expecting the interest rates to fall in the longer run, the curve may be an inverted curve. So the key is that the long-term interest rates reflect the average of current and expected future short-term interest rates. Now, what is the implication of this theory? The implication of this theory is that the yield curve shape is reflection of a market participant's expectations. If you are expecting your interest rates to go up in the future, your yield curve may be upward sloping. If you are expecting your interest rates to go down in the future, your like you will be having a kind of downward sloping yield curves. Okay, so this is an example here. As I was telling you, that suppose the current rate on 1 year bond is 6%. Current year on 1 year bond is 6%. And what are you expecting on the 1-year bond after 1 year? You expect the interest rate on a 1-year bond to be 8% next year. This year, if you are making investments for 1 year on the 1-year bonds, you are getting 6%. But the next year, if you make investments on 1-year bond, you will be expecting that you can get 8%. So at the place of these two different interest rate, or two different terms bonds, if you buy 2-year bond, then what will be your expectations? Your expectations will be average of the two interest rates. Like say, for example, this year 6%, next year 8%. So the average of the 2-year will be 6% plus 8% divided by 2, which is 7%. So it means that in the current period is 6%, in the long term you are expecting it to be 7%. So you may know that if you, for 1 year, you are expecting it to 6%, for 2 years, you are expecting it to 7%, for 3 year, even it will be greater than the 7%. So the yield curve that you will get between 1 and 2 years here, that will be kind of, like an upward sloping curve. Okay. And if this opposite happens, the opposite means, like say, for example, your current interest rate is 8%, but you are expecting interest rate to fall to 6% the next year, then your average return expectations from that investment will be 7%. Okay. So this, that is again the 7%, but that 7% will actually yield you a negative sloped yield curve, because in current period it's 8%. In the next 2 years, you are expecting it to be 7%. Okay. So the interest rates on a 2-year bond must be 7% for you to be willing to purchase or make investments for 2 years. Now, technically, this is the formula. Like say, for example, for investments of $1, interest rate today is the interest rate on the first period, and interest rate T plus 1 is the interest rate the next year. Okay. So the two years interest rate is represented as I2T. Now, if you look at, this is the formula here, so which is of your concern, like this formula. The average 2 years interest rate will be the average of this year interest rate, IT, and future interest rate, expected T plus 1 interest rate, and divided by 2. And this formula can be extended to any value depending on, like say, for example, here you were making investments for 2 years only. You may also make investments for 3, 4, 5, 6, 7 years. So that will be again depending on that, this formula will actually be increasing. If you have got 3 periods, you will be dividing with 3. If you have got 4 periods, you'll be dividing by 4, and something similar. Okay. Okay. So another theory that we use in financial markets to explain the shape of the yield curve is called the segmented market theory. This segmented market theory suggests that different investors have preferences for different maturities based on unique investment needs and constraints. As I was telling you, that when you make market segmentations, you divide people in very different kinds of, ideas. The idea is that you are having people of different kind in different markets. Like I was giving you the example of an airplane, and an airplane, when it travels from Karachi to Lahore or from Pakistan to England, it has got different classes, and these classes, the people who sit in those classes actually are different in terms of their preferences. What kind of preferences they have? Like the people who are sitting in the economy class may have different preference from the people who are sitting in the business class. And similarly, the people who are sitting in the middle of these two classes actually have got different preferences. Something similar happens in the bonds market. In the bonds market, this theory suggests that different investors have preferences for different maturities based on their unique investment needs and constraints. Everyone has a different constraint, everyone has a different need. So what is the explanation of it? Investors may have specific time horizons for preferences for short-term or long-term investments. If there is a higher demand for short-term securities, the yield curve may be flat. If there is a higher demand for short-term securities, the yield curve may be flat, reflecting similar interest rates across different maturities. So investors may have different specific time horizons for preferences or for short-term or long-term investments. So you may basically, like the people are demanding higher, they're demanding highly for short-term securities. The yield curve may be the same, like flat in the longer run, because the people may be actually expecting the same return in the future as well. So the implications, what are the implications? This theory suggests that supply and demand dynamics with different maturity segments of the market determine the shape of the yield curve. So every market has a different kinds of demand and supply mechanisms. So like that may be a flat curve depending on the preferences of the people, and that may be having a different kind of a shape as well. So, so that's determines the shape of the yield curve with each segment operating somewhat independently. Okay. So another theory, which is a very important theory along with these two theories, which actually is used to explain the nature and shape of the yield curve, is the liquidity premium. Liquidity premium, like when you compromise for the liquidity in the longer run, you require some premium to get compensated for it. So the idea for the liquidity preference theory is that that was actually explained by John K. Maynard Keynes. He suggested that the investors demand a premium for holding a long-term securities to compensate for the additional risks and uncertainties that they take. Like say, for example, if you are buying a bond for 1 year as compared to you are buying a bond for 2 years, if you are buying a bond for 2 years, you are actually going to go and your investments are going to last for 2 years, and the next 2 years are not certain. Although the first year is also not certain, but the two-year period is even more uncertain than the 1 year period. Similarly, the longer is the period, the higher will be the uncertainty associated with the future. Okay. So what is the like the explanation of it? The long-term securities are riskier. The long-term securities are very riskier because market conditions and investors' needs may change over time. So therefore, if you want to attract people for the long-term investments, or if you want them to hold long-term securities, the yield curve may be upward sloping, because if you want them to actually make investments for longer run, you will have to give them the liquidity premium if they want to hold your investments for the longer period of time. Now, what is the implication? This story emphasizes the risk and uncertainty associated with long-term investments, leading to a higher compensation in the form of higher interest rates. So it may actually lead to the higher, the positive slope curve. Now, this is the idea or the basic expectation, but along with that expectations, you are actually adding this, this liquidity premium. This is what makes it different from the expectations theory formula. In the expectations theory formula, the long-term interest rates could be for actually can be lesser than the short-term interest rate as well. But here, the long-term interest rates will not be less than the short-term interest rates, because if you are making investments for the longer run, you will be requiring the premium in terms of the liquidity. Okay, so this is the premium that you add to the expectations of the future returns, even if the future returns are falling or as compared to the current returns. But since you add this liquidity premium, which is higher amount, so that actually increases the value. Okay. Another theory is related to this kind of a theory as well. It is called the preferred habitat theory. If you think about a bond market as a bustling apartment complex, like say, for example, what kind of housing people require, instead of regular apartments, we have different maturities. Like say, for example, we have got different maturities, maybe short term, long term, and very medium term and long term. Like say, for example, if you compare this bond market with the housing market, so as you know that in the housing market, you have a different kinds of houses available in the house market. Like say, for example, some are studios. Studios perhaps are not very common in Pakistan, but generally, like very poor people live in these kind of studios. What is the studio is? It is just a one room that contains everything: the toilets, the kitchen, and it's just bigger room that basically kind of contains everything. They don't have got separate bedrooms or dining rooms or TV lounges or drawing rooms, etc. They have got a studio flats or studio apartments. And these studios basically are kind of a very compact size of rooms, which actually contains everything. Contain everything means like, they actually have got the bathrooms and everything inside. The one bedroom house that may be like, resemble to the medium term investments, and penthouses, big houses that can be, like this resemble to the long term investments. So investors, like tenants, the people who take the houses on the rents, have different preferences for them to live. Like, say, for example, the young investors, the people who are students, or the people who want to actually hire a house for a short term, they may prefer the studio flat because they need more flexibility. They have to live for a shorter period of time. So they basically don't want to make more investments. So they buy studio flats, or they actually rent the studio flats and they live into that. And that is similar to a short-term investments. The short-term investment means the small investor makes generally the short-term investments. As compared to the short-term investors, the people who actually are like going to make investments even for a bit longer run, which may be called the medium run. So they basically may prefer one bedroom house, and in which they want to stay a bit longer. They want to stay for a long period of time, because you cannot stay into the studio for a very long period of time because of the facilities available there. But you can stay for a medium term into the one bedroom house. But of course, one bedroom house is not also very good for you in the longer run, because as your family members increase or your needs increase, basically you cannot be able to accommodate your whole family into one bedroom house, so you will be needing a bigger house. And that is what basically for the medium term you may stay in the one bedroom house, but for the longer run, for a long term investments, you need a penthouse, big house, which is a long term bond. So if even the yield is higher because they are invested in the longer haul, because they are actually, like, say, for example, the people who want to stay for the long period of time, they basically, like have, they want to pay more for the facilities they are going to get. So this is something similar to the, liquidity preference. So again, the idea is to summarize is that the investors have certain preferred habitats, like, as the animals live in the different kinds of habitats, the investors also have got different habitats, and or maturity ranges where they prefer to invest based on their specific preferences. Their habitat is defined, like, say, for example, some animals are the animals who live in the very cold areas, like the polar bears, and some animals live in very hot areas, and there are so many, like, different kinds of animals who actually acclimatize with different kinds of environments. Something similar happens with investors. Investors have different expectations, different preferences, different risk tolerances. So according to this theory, investors are not influenced by current market condition, interest rates, but also their individual preferences and expectations. So that's what basically is something related to that. So what are the implications for the yield curve? If you think about the preferred habitat theory, so the yield curve can be influenced by shifts in investors' preferences across different maturities. And if there is a general preference for short-term securities, but investors are willing to move to the long-term maturities for a higher yield, the yield curve may exhibit upward sloping curve. Okay. Conversely, if there is a strong preference for long-term securities, the yield curve may be flat or even inverted if investors are willing to accept lower yields for the perceived safety for the long-term investments. Okay. So if you are willing to take long-term investments, even at the short, like, the constant rate, that is your preference. That is the preference that you basically, if you want to just ensure safety, or you want to get a longer term into investments, you may expect some, like, flat rates in the longer run as well. Okay, so this particular kind of a preferred habitat theory suggests that the shape of the yield curve is not solely determined by the market forces, but is also influenced by the preferences and behavior of the interest rates investors. So this is something similar to the segmented market theory, and it recognizes that the investors may have preferred maturity ranges, but are willing to adjust their investment choices if they are adequately compensated. So this is the, like, these are the possible shapes of the yield curves. Like, if you look at that, this is a positive upward sloping curve, which is going from, like, this corner to the top. and this is something. This is the flatter. This is the horizontal, and this is a downward sloping curve. So it's a bit a flat curve, flat in the sense because you are not expecting things to change a lot, and here you are not expecting to change. You are not actually expecting the change to happen at all. So, and here the change that you are expecting in the long-term interest rates is negative. Okay. So this particular lecture ends here. This particular lecture about this term and risk structure of the interest rates.